Okay, Intel, ticker INTC, trades on the NASDAQ in the semiconductor and semiconductor equipment space. They are currently at $49.86 a share, and Intel is the world's largest chip maker, and they make microprocessors for personal computers and data centers, and Intel is also the architect of the x86 microprocessor. Year to date, the stock is up 4 cents or 0.08%, so just about even on the year. And if we look at the 5-year, we see that Intel is up $16.25, good for about 48%, so almost up 50% over the last 5 years. Intel has a market cap of $201 billion, an enterprise value of $206 billion. Now, a lot of you know, but if you're new around here, new to this, enterprise value is the entire value of the company, so that's all their debt. That is just the whole shebang. If you wanted to buy Intel, everything that they have, everything that they owe, it would cost you $206 billion. So kind of a neat little way to see the difference between the market cap, which is just the amount of outstanding shares times the stock price. The enterprise value factors in debt for a company. And check it out, 63% of institutional investors hold onto Intel shares. So that's pretty high. They're pretty confident right now in holding Intel. Trailing 12 months, they have earned $5.15 per share. Price to earnings of 9.62 with a forward PE of 9.38. And if we compare that PE to the sector median, it's 70% below the sector. Price to earnings is simply the share price divided by the earnings. That gives you the PE. And that tells you how many dollars you have to pay for every $1 of earnings. So in this case, in Intel, now this is Seeking Alpha, a little bit different than Schwab, what I was using, but we see 9.61. So you're paying $9.61 for every $1 of Intel's earnings, and the 5-year average is 14.10. So Intel is currently 31% below their 5-year average PE ratio. We'd like to see a return on equity in the high teens. Intel's currently at 25.63. Check that out. The S&P 500 average return on equity is 10.07. So you kind of want to be better than that benchmark. So 25.63 is killing it. Earnings per share from 2018 to 2019 was up 6.6%. and another 4.9% from 2019 to 2020. So modest earnings per share growth, could be a little better, but good for 16.2% earnings per share growth over the last 5 years. So the revenue, which is the same thing as sales, their top line, so to speak, from 18 to 19 was only up 1.6%. Now we want to see that growing a little bit healthier than that. So 8.2% is pretty good from 19 to 20, but they're estimating that it will drop 5.5% from 20 to 21, which is probably why Intel is down a little bit off their highs right now. The year-over-year growth, though, is 7.1%. The cash flow, check that out. We need to have good cash flow. You want to see cash flow growing 12.3% from 18 to 19, 9.9% from 19 to 20. So modest 10.5% annualized 5-year growth rate of their cash flow. Take a little look-see here at the dividends. So no growth from 2013 to 14, but pretty steady, 7, 8%, 4%, 11%, 17 to 18. That was a big jump. And it's just steadily been up and to the right. So they've been growing their dividend pretty steadily since 2014. The next ex-dividend date, depending on when you people are watching this, is November 4th. So you got to own the day before November 4th to qualify for that payment of 34.75 cents on December 1st, 2021. That $1.39 annual dividend rate is good for a 2.81% yield, which is very nice for the sector, and a really low payout ratio of 26.75%, which we want to see those numbers below 60% if you want the warm and fuzzy feeling that they're going to be able to keep increasing that and having enough money left over to put back into the company. The 5-year dividend per share average is 2.53%. And yeah, if you look at their peers, like I said, Intel's at 2.81. Texas Instruments is at 2.45% yield. Qualcomm 2.04, and good old Applied Materials AMAT is at 0.70%. And very healthy 10-year growth rate. Check it out, 7.7%. Love their dividends, which is making me really interested that they have no problem paying and raising that dividend as things are right now. So some things I like about Intel is that they are looking to be a foundry. They're looking to make chips for everybody. That's how they want to try and start expanding their revenue, getting that top line growing again. They also acquired Mobileye, which I really love. Mobileye is the autonomous driving technology. That is what is the future, because it's coming. Sooner or later, we're going to have autonomous vehicles driving us around. And I think that's pretty cool, because imagine all the time you would have to yourself to not have to focus on the road. And I would love it, because I would get to read and I would get to do more research for you fine folks. But I don't like they haven't had a significant impact in the smartphone market yet, which is only going to keep growing and expanding. And also they have to spend a lot of money on research and development, because it's a very, very competitive space, and supply chain disruption is something that we're going through right now, but that too will pass for Intel. So all in all, I'm going to give Intel a thumbs up. I think this is a great turnaround play. I like what I've seen from the quick metrics I looked at, and I would not hesitate to buy a small starter position. And if things turn around and flourish, then I would feel comfortable averaging up from here. Hey, so what's up? I'm Russ, and thank you for making me a part of your investing journey. I really do appreciate it that you're watching me and letting me share some of my knowledge that I've accumulated and acquired over the past almost 20 years that I have been investing. And if at any point you are helped by this video or the information, I would really appreciate a like and consider subscribing to the channel. Next, we're peeking at Lockheed Martin, ticker LMT. They trade on the New York Stock Exchange, and they are in the aerospace and defense sector. Now, Lockheed Martin is the largest global defense contractor, and their biggest project is the F-35 fighter jet, which does account for 30% of their revenue, as well as the helicopters, or the helos as we call them in the Navy, and missile defense and space systems. Year to date, Lockheed Martin is down $28, which is about 8%, but over the last 5 years, they're up $90, which is 38%. Market cap of $91.3 billion, but an enterprise value of $100 billion, so about $9 billion in debt there from what I can tell, and 72% of shares are held by institutions, and a pretty low short interest underneath 1%. Last 12 months, Lockheed Martin brought in $21.67 per share with a price to earnings of $15.27, but analysts think that's going to pull back a little bit with a forward PE of only 14.57. So that 15.24 PE compared to the sector median is about 40% below, and about 32% below their 5-year PE average of 22.62, as well as their forward PE, which is again expected to drop about 36% below the sector and about 17% below their 5-year average of forward earnings that are expected. So Lockheed Martin's return on equity is 83.08, which is a little bit high and skewed because of their high level of debt. Big earnings per share growth, 25.8% from 18 to 19 and 11.6% from 19 to 20. Good for a 19.8% annualized 5-year earnings per share growth. Their top line, same, 11.3% from 18 to 19, 9.3% growth from 19 to 20, and they're expected to cool off a little bit and only have 2.5% growth into 2021. That's 10% 5-year annualized growth rate, and the cash flow really big and stout for Lockheed Martin, up 21.6% from 18 to 19 and 11.2% from 19 to 20. Good for 15% compound annualized growth rate of their cash flow. Lockheed has been increasing their dividends for almost 20 years. So just going back to this chart, you can see up and to the right, every year double-digit growth, except from 19 to 20, but just like clockwork, about 10% increase of that dividend every year. The annual dividend's currently $11.20, good for a 3.38% starting yield, and that's $2.80 a quarter. Payout ratio only 48%, so under 50%. That 10-year growth rate, though, check that out, 14% for Lockheed Martin. Now, compared to their peers, they're at 3.38%. General Dynamics, which I also do own, is at 2.36%. Raytheon, 2.30%, and Northrop Grumman only at 1.77%. So by terms of annual dividend yield, Lockheed Martin looks incredible. And yes, some people here might think they're expensive at $326, but again, always remember that is not indicative of a company's value. That is just what the shares are trading at. So again, the F-35 is their largest weapon in company history, accounting for about 30% of revenue. And that contract is expected to extend until 2070. So the way I see that, unless something crazy happens and that contract is broken, that's 30% of their revenue. That's guaranteed until 2070. And as a prime defense contractor, they are basically in an acyclical business, which is great when recessions happen. Lockheed Martin, like all defense contractors, that's going to be affected by the defense spending budget here in the United States. And again, as much as that 30% of revenue from the F-35 is a positive, if anything should go awry or there's cost overruns or again, any contractual obligations, then that could become an issue because a hefty chunk of their revenue is tied to that F-35. And as much as I love that they are in space with satellites and space transportation, you know, there's a lot of startups like SpaceX and others coming along that really could cut into that source of revenue for Lockheed Martin. So I think Lockheed is solid. I don't think they're going anywhere. I think they have a steady source of revenue from the defense sector, from the government that's coming in. And I have been buying more, and I plan on buying just a little bit more to round out my position of Lockheed Martin. So for a long-term buy and hold, I give a thumbs up to Lockheed Martin. All right, now I've seen a lot on the internet about ticker PCI, the PIMCO Dynamic Credit and Mortgage Income Fund. Boy, is that a mouthful. And just right off the bat, I'm going to tell you if I like this or if I don't like it. Closed-end funds are not my area of expertise. A closed-end fund basically means that there is a limited number of shares, it's closed, and it trades on the stock exchange throughout the day. The price moves, and it has a net asset value, which you can, of course, because it trades throughout the day, you can buy it above or below the net asset value, where open-end funds, like we have in our 401ks and mutual funds, most of us, those close and rebalance basically at the end of the day to be in accordance with the net asset value of all the assets that are contained in the fund. Year to date, PCI is up 1.83%, but if we look over the life of it, yeesh, down 14.73%, and look at that, in mid-February of 2016, we're under $17 a share, and then of course dropped with everything. So it's basically chopped sideways, but throughout its life, but it's still down 14%. Now we see here the dividend yield is 9.62%. So let's go to their website and see what more we can find on PCI. All right, so let's take a quick spin through this. So here I want to point this out. The daily market price, $21.56. The daily net asset value is 20.19. So that current market price is 6.79% above the net asset value of everything contained in the fund. So you're paying about a 6.79% premium for all those assets in the fund. And as we see the objective, they say to seek current income as a primary objective and capital appreciation as a secondary objective. So they're not worried so much about the capital appreciation as they are the income, which is kind of funny because that's kind of what I do here as a dividend growth investor. And these are the three managers. So these three gentlemen, fine gentlemen, I'm sure they are the people who manage the PCI fund. So it's actively managed. So the market distribution rate is 9.88%. And we see that over year to date, it has been paid out, distributed $1.74. But this is what I don't like at all. The total expense ratio, including interest expense, which you're paying, is 2.91%. So that factors in to your distribution rate. So that's going to knock it down quite a bit. In my opinion, that's knocking it down to currently Altria levels, which I would just rather buy Altria. But anyways, 2.91% is what you are paying. So for every $1,000, that's $29.10 that's going to run you. So the trick with these closed-end funds is if you can buy them below the net asset value or as close to the net asset value, but look at the high-low for the NAV and the market price. The highest that the net asset value was $20.73. The highest that the stock was $23.24, and the lowest net asset value $18.79, and the lowest was $19.10. So that's kind of the tricky thing. I wouldn't hold on to this long term, and if you can find it below the net asset value is when you would buy it. Now, why wouldn't I hold on to this long term? It's because of this. Look at their sector allocation. So they do invest in stocks, and you can see aerospace and defense, Lockheed Martin. I don't know if that's one of their funds. You can check that out. And then you just get the rundown of everything. But there is a lot of mortgage debt, mortgage-backed securities, high-yield credit, emerging market funds, municipal bonds. There's a lot of bonds. They have all these other bonds over here with, you can see the maturity, holding some 20-plus year bonds. So this is just a really big mix, international. Most of it is in the United States, some in the Netherlands. Yeah, it's just a lot. So that's all fine and good. But what I don't like is the leverage that it uses. I don't like these leveraged funds, which is 45% of the managed assets. And check it out, 43% is in reverse repurchase agreements, and the other 2% is in credit default swaps. So those are financial derivatives that I don't have expertise in, and you are putting your trust and faith in those three fine gentlemen that they are going to run this effectively and keep making you money. So let's see if it has indeed made you money. Pfft. And if we pull up their distribution history, check that out. We'll start at the most current. Now they do pay this monthly, 17.174 cents every single month. And just quickly go down. They do have special dividends in December. They didn't do one in 2020, obviously, for reasons we all know. But so here from June of 19 to July, they gave a raise from 16.4063 micros to 17.4 where they're at and 35 cents. So I don't see a cut yet. 164063, 63 cent special dividend in December of 16. No cuts yet. Special dividend 23 cents in December of 15. There's a raise there from 156250 to 164063 in August of 15 to September of 19. So there was a raise there, and 59 cent special dividend in December of 14. So 156250 still going all the way to their first in March of 2013. So I don't see any cuts, which is good. But remember, you're paying that expense ratio for PCI, which is really high. To put that in perspective, there is a similar Vanguard index fund called the VMBSX, the Vanguard Mortgage-Backed Securities Index Fund. So it's not completely apples to apples, but it's in the ballpark. And let's see, over the year to date, this is down 1.89%, but max lifetime, look at that, up 5.67%, and the expense ratio is 0.07%, but you're paying less in yield, which is 1% you're going to get. So in my opinion, I just wouldn't invest in something like PCI. The only way I would see myself buying it is if it was below the net asset value if it was trading below the NAV for a discount, and then I would wait till it rose back up and I would sell it, which I assume is what a lot of people do. So it probably doesn't sit below the net asset value for long. But if you're buying it for income, I wish you luck. They haven't had any issues since 2013. They've consistently paid every month, and they've had a few increases in there as we saw. But just be aware that 45% of that portfolio is levered, and it's levered in financial derivatives, which, I know they stress test banks and things, but just that's something to be aware of, that something like that could get smoked if there was another big financial crisis. So, it's not for me, but if it's for you, let me know. What is your opinion on PCI? If you own it, I'd love to know. Share with all of us what I've missed or what you think we should know about PCI, Lockheed Martin, or Intel as well. And again, if you had any value at any point in this, if I've helped you on your investing journey, you can always buy me a beer on the link below. I would be forever grateful, and I would give you a shout out on the next video. These numbers here, click the link at degrin.com below. Also, there are 3 different portfolios that I share. 2 are retirement, but this one is the bridge portfolio, which is taxable, and this is the main one that I like to share and the one I'm most active in. So you can click the link at degrin.com below and check that out. And please, if you're interested in Lockheed Martin and some other companies that are involved in space, one of those in there, you'll never guess who it is. When I think of them, you think mason jars, but space? Check it out right here, find out who it is, and I will see you there.